Hey everybody, welcome back to the channel. Palantir just had their Q4 earnings a week ago, and one of the most interesting things in those Q4 earnings was that Alex Karp, Palantir's co-founder and CEO, was live on the call. This is one of the first times he's actually been live on the call. He was taking questions from analysts from places like Morgan Stanley, and also from people in their home recording off their iPhone, i.e. retail investors. And there were a lot of questions discussed in this video conference. We'll probably go over in some future videos some of my deeper thoughts on other questions, but one question in particular sticked out, which was from a retail investor, and it was the question around stock-based compensation. Stock-based compensation is basically Palantir's ability to get high-quality talent, some of the smartest engineers in the world, and I did a video on why they get some of the smartest engineers in the world, I'll put that in the description, away from places like Google, Facebook, Amazon, Tesla, etc. It is very difficult as a growing company, basically almost like a startup. They've only been public for the past 2 years, even though they've been in business for the past 17 years, and they're putting up startup-like numbers, to actually get talent that motivates that talent to stay within the company, not take a fat check and some fat equity from other places, and also take a risk on the potential of the company, because you're giving them a lot of stock, but if the company doesn't execute, then that stock is worthless. But if it does execute, now those people have the incentive to make sure it executes because they have stock at a fairly cheap price. And with Palantir being $11 today, if they have options that vest at around $40, $50, there's a decent return for those employees. It also motivates those employees to stay for a long amount of time in order for that stock to actually vest over the next 4 or 5 years. Now, as a result of this has made Palantir not profitable. They are operationally profitable, meaning if you reduce their stock-based compensation, which was I think around $170 million roundabout for Q4 of 2021, they would be making a profit. But instead of making a profit, they are not profitable by GAAP principles, generally accepted accounting principles, at the tune of negative 14% because they have so much stock-based compensation. So this retail investor brings up a really good point, which was like, when is it going to stop and how do you feel about it? And I thought Carp had a strong response to it, not just from the perspective of the numbers, but from a perspective of the philosophy of why they need to reduce dilution and stock-based compensation. Let's get into it, let's analyze, and let's see what Carp had to say.
On all the hard work. It seems like you guys have a great team and are executing really well. From a retail investor perspective, the most negative sentiment I hear regarding Palantir is in regards to the dilution of shares outstanding over the past 12 to 18 months, and primarily in relation to stock-based compensation that's occurred. Other than the remaining shares to be vested that have already been announced, can we expect further dilution and share offerings going forward? Or is it kind of reasonable to assume that the majority of this was from the IPO process and sort of a one-time event for the company? Once again, thanks and congratulations on all the hard work and business developments.
Thank you, and I really appreciate you investors. Thanks for investing and the faith you have in us. Okay, so there's like the simple version, which I think, it's like, so there's stock-based comp and there's dilution. The dilution thing, that's a red herring. We're not issuing a lot of new shares. I think it's like in the $9 million range. And so
a red herring is a term used in communication of like when you make an argument and you make another argument to distract from the original argument. So when Carp is like, all right, if we're going to talk about shares and stock-based compensation, don't bring up dilution because we're not issuing that many shares. We're issuing about $9 million worth of new shares, and they already issued about 2 billion shares when they went public in their S1. So every time people have said they've been diluting you, it's not really being diluted because they already issued these shares. They've just been starting to give out those shares now. So he's basically saying dilution is not the biggest concern here, and we're only doing about $9 million worth of dilution this year. So it's not something to sort of be really strung up upon.
It would be a little coy of me to say that's like no issue, move on. The thing to understand about Palantir, and then I want to just hit this, is like it's actually not the result of the DPO. It's the result of the fact that we were completely focused on building product. We had no earthly idea we were going to DPO till like right before we did it. And so most companies are, quite frankly, built so that when analysts look at it, the primary customer of most software companies is not the client, it's the software analyst. So it's like we obviously, our primary client are our clients, which doesn't mean, now we're thinking about how do we expose the data in a way that, people on the outside like you and professional analysts and others can look at the data and get a better sense of what's tracking and what's not tracking. But the primary source of a lot of these questions really comes down to, look, we built the company to support the U.S. warfighter primarily, and then dual use it for the glory of humanity, particularly humanity in the West. That was.
Let me explain what Carp is saying here. Now, this may be a little bit confusing. The reason Carp is like kind of throwing shade to analysts right here, even though he doesn't mean to be throwing shade, but for some reason this guy just always ends up throwing shade, is because his argument is like stock-based compensation is just to get the best talent. So like the only reason it's a concern is because we've gone public and like analysts now care about stock and retail investors care about stock-based compensation and dilution and all that stuff. His argument is like, we were just trying to get the best talent and giving them good stock to create the best product. So it was never a question of like, should we not pay them in stock or should we not pay them in equity? Because it only matters if you have to go public and show people the data of how much money you're spending on your talent. But if you're a private company, no one gives a crap. Literally no one gives a crap because you don't have public investors to be held accountable to. I mean, maybe your private investors give a crap, but outside of that, you can give as much stock as you want because if you can continue building the best product because you have the best talent, because you've incentivized the best talent by giving them the most amount of stock in forms of compensation, then you're just going to keep building the best product. But as a result of the DPO that they didn't really know they were going to do until they finally did it, now the world cares because obviously our money is at line as public shareholders. So the first step of his argument is by saying, look, it's about talent. It's about getting the best people to actually care about the product. But now that we're public, we have to be accountable to stock-based compensation concerns. And that's what he's going to get into right now.
Was our idea. And because our primary client was not what someone at a hedge fund would think, we didn't actually think of these things from inception. And so now there's a process of normalization. You're going to see that in going forward on these calls. It's like, how do you normalize? How do you provide data that people can look at? How do you provide data that people can understand, that they're used to seeing, while simultaneously staying true to what our mission is? It's like our primary clients are the people we're serving. We're in full line with them, and that's why we survive. Even with the nascent sales force, you can get things to double, which is insane. So then you.
And real quick here, he's saying the reason we doubled with a horrible sales force is because we had the best people, because we paid them in stock. Now on these calls, we have to normalize the process because we have to actually think about hedge funds because now they're a public company, right? They didn't think about that before, of how to communicate this stuff and ultimately how to make sure everyone's interest is aligned. But a year ago, 2 years ago, they weren't worried about that. And that is something that is now a concern and now something that will be addressed.
You get to stock-based comp, which is like, okay, so there's two parts of it. Of course, IRI people kind of don't want me to do any kind of forward-looking math, but if you're smart enough to invest in Palantir, you're smart enough to figure out there's essentially there's the how are we comping people, and there will be a normalization that will get us into a range where you would see in a software company within the next 18 months, latest 2 years. But there's essentially, and that's going to take a little time. It is going to happen because it's also very much linked to another question, which is how do you actually run the company so it's profitable someday on a GAAP basis, not stripping out comp, and that is also within eyesight. And those are goals for Palantir because same reason we have no debt, same reason we have $2.3 billion on our balance sheet. This is a company built for bad times. Bad times mean strong finances internally, and that means at some point you have to be GAAP profitable. You can't be GAAP profitable if you're diluting people or correctly. Your stock-based comp is totally is not in conformity with other companies. So you're seeing a normalization. This will change. It will change in the relatively near future. It'll be linked to other things that we believe are important for Palantir, like having a company that thrives in bad times. And we are,
So let's analyze that real quick before we continue. This part was, I think, the most significant part of the entire call. Carp is saying for us to be GAAP profitable, we have to get rid of stock-based compensation. It is not aligned from a investor perspective and a company perspective to not have good profitability, right? Obviously, that's a good thing. Carp's not an idiot. He knows if the company is profitable and it's growing at 30% year over year, Wall Street will reward them, but they're not profitable because they have all this stock-based compensation. But he's stuck within a rock and a hard place because he's like, well, how am I supposed to compete against Google and Amazon and become the biggest software company in the world if I can't get the best talent, which means I've got to give up something. And in this case, I am going to give up short-term profitability in order to get the best talent, get those people in, build the best thing, and eventually, especially when we went DPO, I said, hey, don't invest if you're in this for the short term. We will be rewarded long term, but in order to get to that long term rewards of appreciation of the share price, we need to sacrifice that short term profitability because they could literally be profitable tomorrow if they decided to get rid of stock-based compensation. So that's one of the most important things he mentioned. And his argument here is so interesting because he's like, look, we have $2.3 billion on the balance sheet. We thrive in bad times. Why are finances good internally for Palantir in bad times? Because we prepare for those things and our product is ready to excel within those bad times. So he's like, everything is normalizing around this company from a public shareholder concern perspective. SBC is one of the things that we haven't gotten to yet, but we need to get there in order to remain profitable, showing there is an interest between the company and the investor. A lot of people are like, oh, Palantir is just using your money to like get rich and like sell off stock and like issue more shares, right? Dilute. The problem with this argument again is because it misses the fundamental concern of how the moat of this company, which is software, is going to compete against the moat of all these other powerful software companies unless they have the best talent. As a result, Palantir is not going to be getting rich. The share price is not going to be appreciating. The stock-based compensation they gave is not even going to mean anything to employees unless the stock price goes up, unless they stop diluting and get rid of SBC. And this is the point I really want everyone to get out of this video. If you're an investor, if you're not an investor, if you're thinking about Palantir, how can the company issue hundreds of millions of dollars of shares worth 10, 11 bucks and incentivize employees to stay because of the appreciation of those shares if the share price never appreciates? Like if your stock price never goes up, those employees basically were granted something as a promise that they never got. Those aren't real dollars. Those are tied to the stock price. So those employees are not going to get rewarded with the upside of the stock price unless the stock price goes up. How do you get the stock price to go up? You got to play the Wall Street game. What's the Wall Street game? Become GAAP profitable and grow a lot. Palantir is doing the growing part really well, but they're not becoming profitable because in the short term, they need those employees to at least come and give them an incentive to stay. So the point here is that there is an incentive for them to become profitable because that will lead to their employees actually making money off the SBC they gave them, which means that interest of the company becoming profitable and not diluting and not giving excessive amounts of stock-based compensation is fundamentally philosophically inclined or in line with retail investors and public shareholders as well, because obviously we want them to be profitable.
You know, bad times are very good for Palantir because we build products that are robust, that are built for danger, and then the finances internally are actually built for bad times. And bad times means you have free cash flow. The free cash flow turns into GAAP profit. That means the stock-based comp has to be one that's aligned with our investors. Also because that's basically, you know, it's part of a little bit longer philosophical narrative, but like if software is the only moat, then value and growth shares have to be evaluated in terms of their value. Value only exists if you can actually get a tech moat, call it, maybe it's something besides, and growth only exists if you build a company that is where the technology is strong enough, the business fundamentals are strong enough that the free cash flow actually turns into GAAP profitability, and that's linked to stock-based compensation. So this is a priority both because you care, but also, quite frankly, because it is the health of our company, which we care a lot about.
That is the big point I also wanted to stress at the end. This was the part that I really don't think this question got enough shine or people got enough analysis. My hair is kind of crazy, kind of like Carp, but this was the good part, right? He was like, if technology is the only moat that gives it the only value, so we have to make sure we have the best tech in order for our company to have any value, right? So he's talking about value and growth stocks. Well, okay, the value is only tech. Tech is the only moat, software. So how do we get the best moat? We got to get the best people. In order to get the best people, we got to give them stock-based compensation. Once we give them the stock-based compensation, they're incentivized to come. That creates the best product because you have the best talent. Talent creates the product. Now you have the best moat. Well, this moat is only valuable if the company and the business is GAAP profitable. How do you get GAAP profitability? You need to have free cash flow. How do you get free cash flow? You have to stop excessive amounts of stock-based compensation and dilution. And to me, this was music to my ears because I'm like, yeah, this obviously makes sense. They have the best moat because they've done stock-based compensation to get the best talent. Now that's going to normalize and be reduced, just like their balance sheet has normalized, just like their internal finances have normalized. Just like they have no debt, right? That is normalized over time. In order for the share price to eventually appreciate, that GAAP profitability needs to happen from free cash flow. That free cash flow only happens from the best product. That product happens because technology is the best moat. They've reverse engineered it to get the best moat because they got the best talent, because they gave the best SBC. Now that stuff is going to start to normalize and scale back. And as long as they continue growing via the tech that they've been able to implement through SBC by getting the best talent, the value of that moat will start to make more sense to investors as they become GAAP profitable because now they don't have stock-based compensation. So to me, philosophically, this just makes all the sense in the world. And I think that is one of the core reasons why I am optimistic for SBC to go down, dilution to go down, and for them, if they can keep growing, for the share price to eventually actually appreciate, because Wall Street is going to see that, oh my God, this company is growing 30, 35% year over year and they're profitable. We should probably put some money in this, because what other asset is growing 35, 30% year over year, right? There's not that many of them. So thank you guys for watching. Let me know your thoughts in the comments. Let me know what moments you thought were the best in the Carp Q4 call. And if there's any questions you would like me to analyze as well, leave those in the description and I'll check those out. Thank you guys for watching. My name is Mitt. I will see you in the next one.